things about our show is it's going to be unique.
You are what you do. You can say any amount of things that you want to say, but what you do is what everybody sees.
People are like, oh, I'm just going to JV it. Like, it's just JV it. Like, what the hell does that mean?
I cannot tell you how excited I am to hang out with you guys today, so thank you so much.
Well, then that end buyer could come back and say, well, I didn't fully understand that it was subject to.
That's not a thing. Like, the SEC has thought of all of these things. They've been here since 1932.
And you can do what you want with your property.
Buyers have time, they have negotiating power, they have options.
Oh my gosh, I'm blown away by your inexperience, and they've been in business 20 years.
And that includes things other people put on your property, right? It's your property, okay? Suddenly, Cousin Jimmy's in a lawsuit.
A novation is replacing one contract or one obligation with another.
Out with the old, in with the new.
Yes.
Good morning, everybody. Welcome to the show. Today, our topic is update on hard money lending. I'm Andy Fowler, and I'm here with Sean St. Clair. If you're new to the show, like our channel. You can find us on Facebook, YouTube, and X. You can find us at the handle @INREM Podcast. That's @INREM Podcast. When we say subscribe and like, go to the channel, subscribe, like it, share it. We really appreciate it. You can also download an audio version of the podcast. You can find that on Apple or Spotify. Go ahead and download that. That gives you a chance to listen to it for free and not worry about a screen while you're doing yard work or whatever else. With that, we're going to go ahead and get started with the show. We're going to turn it over to Sean, who has our legal update.
Thank you, Andy. So my legal update today is, what is a deed in lieu of foreclosure and when is it used? So I receive this question all the time from clients, hey, I want to, and they sometimes call it like a performance deed. I want a performance deed. Can I get it signed in advance? Those types of things. And the answer is no. When a deed in lieu of foreclosure is to be used is when there is a default under a loan, and instead of the lender going to foreclosure, they're willing to take a deed back from the borrower to the property in lieu of foreclosure. That's why it's called a deed in lieu of foreclosure. So a couple of things, though, to be mindful of with a deed in lieu of foreclosure. So the first thing that you have to be mindful of is the fact that when you do acquire the property via a deed in lieu of foreclosure, you're acquiring it subject to any liens, claims, and encumbrances that exist as of the date that you take the deed in lieu of foreclosure, not that existed at the time that you got your lien against the property, but at the time of the deed in lieu of foreclosure. So if you take the deed in lieu of foreclosure and the borrower has a judgment against them that was recorded after your deed of trust or your mortgage, you're going to take the property subject to that judgment. If they have an IRS tax lien or some other claim or encumbrance against the property, mechanics liens is another example. And they're recorded after or effective after the date of your original deed of trust or mortgage. When you take that deed in lieu of foreclosure, you're going to take it subject to all those things. So you definitely want to obtain, as a lender, a title report and make sure that, in fact, the title is clear and is good, and you're not going to be put at a disadvantage by taking the deed in lieu. If title is not clear, not only a title report, but title insurance, you're going to want the transaction insured because that's takes it a step further and actually gives you the protection of making sure that title is clear and you have an insurance product to, assist with that. So once you confirm title is clear and you're going to get your insurance, then you can take that and record it. But if title is not clear, then you have to decide, okay, well, what now? Well, what that is probably going to mean is you can't do a deed in lieu of foreclosure, and you're going to have to go and actually foreclose on the property and go through the process of the foreclosure, so that through the foreclosure process, you wipe out any junior or inferior liens, claims, encumbrances against the property. So that judgment that's recorded after your deed of trust or mortgage, that'll be wiped out through the foreclosure process. The IRS lien recorded after your document, it'll be wiped out. Mechanics lien, if it's effective after the date of your deed of trust or mortgage, it'll be wiped out. So you may have to go through the foreclosure process if title isn't clean or clear for purposes of that deed in lieu. The second thing to keep in mind is in states like Arizona, where we have anti-deficiency statutes, a deed in lieu of foreclosure is not the completion of a foreclosure, and the lender, unless the parties agree otherwise, the lender retains deficiency rights. So if they take a deed in lieu of foreclosure and you as the borrower owe the lender $500,000 and the property is only worth $350,000, the lender potentially could go and file a lawsuit against you for that $150,000. But if the lender actually goes and completes the foreclosure of the property, then in that case, by completing the foreclosure, the anti-deficiency protections will kick in, and there won't be any deficiency rights or amounts owed. So you, from a lender perspective, you want to make sure that title is clear and that you're not going to have any title issues. And then from a borrower perspective, you're going to want to make sure that your deed in lieu of foreclosure agreement provides that the lender is releasing you from any further liability in exchange for you giving the lender the deed in lieu of foreclosure.
All right. Thank you, Sean, for the legal update. Let's go and talk about a couple of announcements. Every Tuesday at 2:00 p.m. Arizona time, we have the Creative Finance Collective. That is where we and other professionals in the area of creative finance, mainly lawyers, from different states and different jurisdictions get together and talk about creative finance, what we're seeing, how the law is playing out with respect to the states that we practice in, what we're seeing is working, not working, problems that we're solving for clients, and we talk about that. But we're also there to answer questions for you, the listener. So this is a prime opportunity for you if you've ever had questions and you wanted to hear from a lawyer's perspective, not just some YouTube guru or whatever else, just a lawyer's perspective on what is done right and what is done wrong with creative finance, what to watch out for, and the things to be thinking about when it comes to that. This is your opportunity. We're on for as long as we get questions and until we stop getting questions. And we're there for max an hour. So join us. It's a good time. It's a great opportunity to engage with us and for us to engage with you. We'd appreciate it. Love to have you. You can find that on Facebook, YouTube, and X, just like this show. Go there. We'll be monitoring the public comments on all those platforms and ready to answer questions. All right. And if you have questions for today's episode, feel free to post those in the chat as you're listening. Don't wait till the end. We try to reserve 15 minutes at the end of the episode if there are any questions. But if you have that question, go ahead and post it in the comment. And we're monitoring that. We will get to those. All right. So today I want to get to our topic. Today we're talking about kind of a market update from the perspective of hard money lending. So we're going to talk about hard money loans. We've talked about this in the past. It's been some time. We wanted to get back to it, address hard money loans, and really kind of take a temperature of the market itself. And with us to talk about hard money lending is Andrew Bang. Andrew, thanks so much for joining us.
Hey guys, how's it going?
Good.
Oh.
We don't have your video,
Oh shoot.
but that's all right. See what you can do to bring that back. But as we go through, we'll talk to you. So Andrew, tell us. You're with Boomerang Capital. Give us a little background on Boomerang Capital, how you arrived. There you are. Now we got you. Are we coming through okay on your end?
Oh, well, it's a little glitchy, but I can hear you.
All right. So tell us about Boomerang Capital and how you got into doing what you do.
Yeah, so I started flipping homes in 2008. I was an accountant before then. I graduated from Arizona State University. And 2008, I went down to the foreclosure auctions at Maricopa County, learned about them, loved it, jumped in right away. I flipped 5 homes in 3 months in March of 2008. And I stopped being an accountant. I did full-time into flipping homes. And and so I did that for 10 years. And as I was down there, I was learning all these new strategies. I was getting into some wholesaling. I had a bid service down at the auction. And then I was also doing some private money lending. But it took me about 10 years to realize that's really where I should focus on. And then in 2018 is when I decided I should go full time into the hard money, private money space. And Boomerang was one of the lenders that I was using when I was flipping. And so I just reached out to them and they said, yeah, we'd be glad to have you come on board. And they were just a small fund, lending mostly in Denver and a little bit in Phoenix. And they said, we want to expand to Texas. So if you come on with us, Texas will be all yours. And I said, that's great. Let's do it.
So as a real estate investor, it sounds like for the better part of 10 years or so, you had a pretty good experience from the investor's perspective with hard money lending. Is that fair to say?
Yeah. I used about 6 different hard money lenders when I was flipping. So I had some experience with different situations, different processes. I really like Boomerang. There's other lenders that I like too. But I definitely saw it from a different perspective. And now that I've been on this side, it's a totally different, it's another different perspective. And it's been really interesting to see, who's flipping homes, which homes get chosen for flips, how to acquire flips, and why flips fail. I actually wrote a book on that topic of what I've seen when I was flipping homes, and then what I've seen as a lender from 2 different perspectives.
Yeah, in fact, I think the first time I think we had on you, the show was Why Flips Fail. And if you're interested and you're watching this show, you can go back. I guess that would have been 2022 or so. And we had an entire episode with Andrew about his experience with flips and what you can do to do them right and what you can do to cause them to fail. So where can, you mentioned you wrote a book about that. Where can folks find that?
It's on Amazon. Yeah, it was an Amazon bestseller for a little bit there. It's called Fix, Flip, and Fail. I'm sure you just type in my name, Andrew Bang, it'll pop up there.
All right, very cool. So let's break this down. And we called this, we're going to talk about hard money lending generally for those that are watching that maybe aren't familiar with the process. But I think, and we called this an update. Oftentimes I think from the lender's perspective, it's a good way to take a temperature of the market as lenders are seeing it, what it's looked like. And I know we talked a good bit about this back in 2022. That was when, the cycle and interest rates were really starting to, increase. We were getting the rate cuts and we were starting to see some slowing. There's been some time since then. So we'll be interested to get your perspective, but just starting out at the beginning here for those that are joining us, maybe they're new to real estate investing. Why don't you break down what is a hard money loan?
Yeah, I lend on distressed properties. Most of the time they're off market, but they're homes that need work, homes that are going to be rehabbed and then resold, so a flip, or rehabbed and kept as a rental. And you can use hard money for a bunch of other different situations, but the easiest way, especially when I'm dealing with real estate agents, is I say, I lend to good borrowers who are buying bad homes. I don't lend to bad borrowers that are buying good homes. So, because a lot of times a realtor will say, oh, you don't pull credit, you don't need an appraisal, you can close in one day. I had this deal, come save it for me. I have this borrower that's buying this beautiful home in Gilbert, Arizona, but they just switched jobs right before closing. And so they're now not qualified for the regular loan. Can you save this deal? And I go, that's not the type of lending I do. I lend on properties that are beat up, that you're getting at an amazing deal. Just because I don't pull credit doesn't mean the people I work with have bad credit. They have great credit most of the time. But we lend on the asset itself. And they're buying it at such a discount and they're putting money into it to add that value that I can lend off the future value, off the ARV.
What are some characteristics that distinguishes, say, a hard money loan from your traditional conventional financing?
Yeah, so I've never pulled anyone's credit. I don't even know how to do it. I've never looked at anyone's tax returns or financials. It's very little documentation that on the front end. It's people will call up and say, hey, how do I get pre-approved for your loan? I go, well, everyone's pre-approved for my loan because it's all based on the property. So like if you're a wholesaler, you can send me a property and then I'll give a quote on it, and then any buyer that wants to buy that quote would stick with that property.
So when you say it's all about the property, break that down for us. I mean, you've mentioned you're looking at, a troubled property, but really the analysis, the pre-approval, as you kind of say, really is more about the property than it is about the borrower. What are you really looking at?
Yeah, I'm looking at what price are they buying it at, how much rehab does it need, and then what is it going to sell for. And I'm really just doing desktop appraisals all day. People are sending me properties saying, "Hey, look at this deal. Would you lend on it?" And I go, "Yeah, this looks like a great deal." Or, because I can say, "Yeah, if you put 40,000 into this and you're buying it for 200,000, and I see it can sell for 350, there's plenty of room. Yeah, I'll definitely lend on this, and here's my numbers on it." And I just have the one loan. I give the same terms to everybody. Yeah, I ask a few questions about the borrower. What's your experience? Have you booked a home before? Do you have any experience dealing with contractors? Are you a licensed real estate agent? Just so I know who I'm going to be dealing with, because we service all our loans in house. It's our own money. We're not selling our loans, and we're not brokering deals. So I need to know who I'm going to deal with for the next 3 to 6 months. But if the property works, I'm going to lend on it.
So if you qualify the property, do you have wholesalers then that come to you and say, "Okay, will you lend?" And then they basically can market to another investor and say, "Hey, look, I already have the loan in place for you. Why don't you take this, contract off of my hands for a fee, of course, and take it off of my hands, and then contact Andrew, and they'll do all the financing for you to do your fix and flip or long-term hold or whatever it is that you need, because it's already there. You don't have to qualify." Do you have wholesalers that use you in that manner?
Absolutely. I love working with wholesalers. And I think wholesalers love working with me because I try to make it as easy as possible. Yeah, they'll send me a property and they know they're going to get 100 calls on it because they have it at a good price. It's a good flip. And if they can, and I'll send them, I try to get them terms within 10 minutes of them sending it to me, because I know it's the good properties go within an hour or two. And then those terms will be good for anybody that call them up. So instead of marketing their property, say they're selling it for 500,000 and they know it's going to go quick, they can go, "Well, I have this property that you can buy with 50,000 down because I'm lending 90% on it." So there's two different ways they can market that property because I've already given them a quote on it.
What is the typical down that you are going to require? Does it depend on the value of the property or what you're seeing with respect to the property? Or is there kind of a number you're always targeting as far as a down payment?
Yeah, 90%. If the buyer is going to cover the rehab themselves, I can go to 90% of purchase. And then if they want rehab included in the loan, I'm normally at 85%. So it's either a 10 or 15% down payment.
Now, are you guys strict on where the down payment comes from?
Yes and no. I want to know where it's coming from. I want to know who's involved. I don't mind partners. I don't mind seconds. There's a big difference between an uncle lending them money to be in second position and some random lender out of New York City giving them money that they've never met before. So if it is a second from a lender they've never met that's out of state, I'm not going to give them 90% on that deal. I'll probably give them 80 or 75%. I want more down because the likelihood of default is greater in that situation. But if the money's coming from a partner or uncle or a father, I'm going to give them regular terms.
What about seller financing for the second?
I don't like it.
Okay.
Yeah, I've seen too many things go wrong. For what I would say is, if it's the first time I've ever met a borrower and they don't have any money in the bank account and they got the deal because they have the seller agreeing to do the second, so it's kind of like a seller carry.
Right.
I'd probably pass on it. If it's an experienced borrower I've done a few loans with and I've seen that they can get a property done, then yeah, I'll make exceptions for them.
Interesting.
Yeah.
Andrew, how does it, for the viewer that's watching that might only be familiar with the conventional type loans, they're thinking, oh, this sounds great. I just got to, it's not so they don't worry about me as much. I just got to find a really good property. But I would imagine the terms on when I say terms, I'm really talking about the duration of a hard money loan looks a lot different than a conventional 30-year fixed mortgage that somebody's going to get on their house. What are the kind of the typical duration that you're going to see on a hard money loan?
Yeah, our hard money loan is 6 months. We'll extend it. We never want any properties back, so if they need more time, that's no problem. As long as they're making their payments, I'll always extend the loan. But our typical turnaround time is about 4.5 months right now. We're at about 100 days. 120 days. And so with these flips, they want to be in and out as soon as they can. And we're at 11% interest in Arizona. We're at 12% in Texas. There's no prepayment penalty, but if it takes them 6 months to flip that house, that's 6%. It's about a 1% a month. And so the quicker they can flip it, the less interest they have to pay me, and the quicker we get back our money. We make our money when we turn it around, when we make our upfront fees. And so we're totally fine with a 1 month flip. That's actually ideal for us. The longer they hold the loan, the worse it is for us.
So that's a fix and flip. Let's say somebody's going to rehab for purpose of a long-term hold. Then the expectation is that they do the rehab, and at that point they're going to basically refinance into a more conventional loan. Is that accurate?
Yeah, we just have the one loan. So if they're going to hold it as a rental, I go, get pre-approved beforehand with your other lender. So make sure you have everything lined up. If that lender has no seasoning, which means they don't have to be on title for 6 months, like a Rocket Mortgage or a Chase Banks, we'll want them on title for at least 6 months. Then they could refinance us out within, a couple weeks or a month, which is totally fine. But if they need more time, that's okay too.
Now, Andrew, as with all of things, this product or a hard money loan is going to work with certain type of real estate investments, and it may not work with others. Now, you've mentioned a few, the fix and flip, wholesaling. Give us an idea, in your experience, what hard money lending does work well for and what it doesn't.
Yeah, so it works best for flips. It works best for buying properties where the seller will only accept a cash offer. Hard money is going to work great for that. I've also seen we do a lot of 1031 exchanges. So if someone wants to buy a 1031, they're selling a property, get into another one, but just the time frame doesn't work. Hard money works really well for that. We've done that. Where it doesn't work is for borrowers who didn't qualify for a traditional loan. They're buying a nice property, and they just want to use our hard money as a bridge. And I say, just wait. It's when you're buying a property at full market value, I'm going to be at 70% of purchase. It's going to be a really big down payment. It's a high interest rate. It's short term. So whatever problem you have fixing that credit or job or assets to debt, whatever it is, just figure it out and then buy the house. Don't use a hard money as a bridge. You're going to end up losing money in the long term.
Yeah, they're kind of rolling the dice at that point, right? I mean, it's like, I don't qualify now.
Yeah.
But 6 months, it's all going to be rosy. And we know how that plays out, right?
Yeah, it's tough because you see people get in these situations and they'll call me up and be like, hey, I've got this other hard money lender. I just need a couple more months. Can you refinance me out? And I go, I'm not taking on anyone else's problems. I don't do any refinances. I don't do any new construction. I don't do any large rehabs. I try to stay away from anything over $150,000. I kind of have the box that I found that really works for Boomerang and us, and the loan that we can provide them. And if we stay within that box, then we find that we get more requests for loans than we have money. So we're instead of increasing what we do, we're actually making that box smaller. And we really want to be the fix and flip lender out there, and it's worked well for us so far.
What kind of regulations come into play with hard money loans, if any?
Yeah, so there's a lot of interpretation there. So you talk to one hard money lender and all the loan officers are licensed, and you talk to another one and they're like, we don't need a license. And it's the way we interpret it is we need to be licensed. So I'm a licensed MLO, and all of the loan officers with us are licensed. We are a licensed commercial bank, but we're set up as a REIT, and we collect certain documentation like a HMDA that we feel that we need. Other hard money lenders don't. Other hard money lenders, there's different ways to interpret the law. So there is, especially out in Texas, I feel Texas there's a lot of people that say they're mortgage brokers or hard money brokers out there that aren't licensed, and they interpret the law that way, which is how they want to do it, which is totally fine. But we're more on the conservative side, and let's take the extra steps. So in the event that we get audited, we're going to be compliant.
Is there any pending or discussed state or federal legislation that's up and coming that could have an impact on hard money loans?
I haven't heard of any. No, I think most of the time I hear about wholesaling. They're trying to cut wholesaling out or limit it in certain places. There's always the amount of interest that we can charge is different per state. So like in Texas, for default interest is where it really hits us. Texas, the most we can charge for default interest is 18%, where we can go to 27, 29% in Arizona. There's certain things like that we have to look out for, but I haven't heard anything else on the horizon.
Is there like a lobby organization or group that you guys, subscribe to that goes to the state and local and federal government and, lobbies on behalf of the hard money lenders or mortgage bankers, that type of thing?
I'll bet there is some smaller ones. There's a group called the Jurassic. They put on an event called Captivate each year. That's where most of the hard money lenders and private money lenders show up and talk about legislation and things like that. We do get grouped in with creative finance. So I know that there's some bills that were passed in Texas a year or two ago, and hard money applied to some of the things that they were trying to get done there. But I don't get too much into the politics and stuff, and in the events I go to, it's really not talked about too much.
So Andrew, let's talk a little bit more about kind of underwriting standards. You've talked about some of this. We'd be curious to know, the last time we had you on was back in 2022.
Mm-hmm.
And things had really started to, we had you on a couple times, and, the market was slowing. We were coming off, I guess 2021, which was probably an unprecedented, type year for real estate investing and things like that. But there was clearly slowing. Obviously, that slowing in the economy was by design. When the Federal Reserve intentionally raises interest rates, that's designed to slow things, right? That's what it does. It takes liquidity out of the system. So kind of break down for us, 2022, how that finished out, moving into 2023, which is a different year, and kind of take us to where we are currently and what that looked like and where you guys currently are at and kind of your underwriting standards and what the market looked like.
Yeah, 2022 was really hard for hard money lenders. It was our worst year in maybe 10 years. We all took back a lot of properties. Anything that we lent on from, I'd say, February of 2022 to June of 2022, it went underwater for a little bit there because those were the highest prices. And so a lot of the first-time investors that got involved, we were giving really good terms there because there was so much competition. Interest rates for hard money got down, I saw, as low as 8%. And so we were all fighting for these loans, which we thought were great, and they turned out they were all bad. And so we all took a hit on the defaults, but we've cleaned those up. We came through it alive. I would say now the market it was really just kind of flat and steady for 2023. Not a lot of ups, not a lot of downs, really where we want to be. And now we're in an interesting situation. I would say the hard money lending market is healthier now than it's ever been, because there's always distressed properties. So we're always going to get that part of the market where people are buying beat up properties. Whether you're a good market or bad market, there's low price beat up properties. The other ones that we're getting now that we didn't get before 2022 is the house that needs some remodeling, where they went with a real estate agent, it went on the market and it didn't sell. canceled and expired listings. But these people still have to move, they still have to sell. So they end up selling to a cash buyer after the listings expired, and then we're funding all those deals. So it's a whole little another market that we're funding deals for that we didn't have before, because in 2021, 2020, you could put a house on the market that had a lot of mistakes, that wasn't perfect, and it'd still sell and still get multiple offers. But those homes are now not selling and they're canceling, and those are people that have to sell.
So you're seeing in the residential space more houses staying on the market for longer?
Mhm. Yeah.
Oh, wow.
I see more canceled listings. I still do. We're in this very interesting place of extremely low inventory and extremely low amount of buyers.
Oh,
and-
interesting.
Yeah, and so, and prices haven't dropped. Like, prices are not dropping; they're just flat. You know, you could even say they've gone up a little bit in the last year. But what we are seeing is houses that are poorly remodeled are not selling. They're taking a lot longer, or they're just not selling.
Now, why do you think it is? I mean, what would you attribute the reason for why homeowners are looking to hard money lending rather than, you know, the conventional maybe cash out refi or whatever else? Is it just that maybe they're trying to secure an older low interest mortgage, or that the current conventional rates, maybe the gap between that and what a hard money rate isn't even that far apart anymore, and you know, they're willing to just consider the short-term hard money loan as a better kind of strategy?
Yeah, no, that absolutely is true, because our interest rates haven't changed. You know, we've been at 11% in Arizona and 12% other states for the last 10 years. You know, I have a rental here in Arizona. I just went to refinance for a DSCR loan, and I got quoted 9.99% for a 30-year fixed DSCR loan. And I'm like, I'm only paying 11% hard money, so what? I'll just keep paying hard money until I can get something better, instead of going through that whole process, ordering an appraisal and all this. And so that's definitely one of the reasons where the gap between the interest rates for investors and hard money is not, it's almost the same.
So, and this brings up another topic, and I just want to explore it because many people think, oh, well, if they're a private lender as opposed to, you know, your conventional loan, can I, if I have a hard money loan at 11%, can I still claim, say, the mortgage interest deduction, even though it's not, you know, a federally insured traditional loan? I mean,
yeah.
Can they, if, you know, do you guys issue like end of the year tax statements and that type of thing?
Yeah, absolutely. Yeah. We send out the interest, all the interest that the investor has paid. We send out, our accountants do all that. Yeah. So they absolutely can claim those as deductions. The only thing with hard money is it's short term. So there's extension fees, you know, every 6 months or 12 months for us to continue to do that loan. And, you know, once we get to a point of 18 months or 2 years with a borrower, we're really pushing them to get out of it, because we need that money back. We need to recycle it. That's not what we do. But we understand the situation right now. So we do have some people in loans longer than we'd like, but yeah.
So you explained how 2024 has given you some new market opportunities, or a different type of kind of participant in the hard money lending space that you didn't see before. What are you seeing from the typical real estate investors, the flippers of the world, the folks that do the type of real estate investing that hard money works really well for? Are you seeing increase, decrease in that kind of activity, kind of in this flat market that you're talking about, where not a lot of buyers, not a lot of sellers? It almost feels like everybody's just kind of holding their breath, waiting to see what the Fed does, and just kind of crossing their fingers and hoping there's going to be reductions. And maybe that's why folks are sitting on the sideline. But what kind of activity are you seeing from the investor space?
Yeah, it's been interesting. So all of our return borrowers went away at the end of 2022. They all said because they took losses. The ones that had been flipping a lot of homes, they had that 6-month period where they took some losses, and then they sat on the sidelines for most of 2023. but we saw them come back. So I'd say the first half of 2023, a lot of first-time investors, a lot of people getting into it for the first time, but then all of them flipped a couple homes and now they're return borrowers. And then all those borrowers that went away in 2022, they've all come back. So we've got a really good mix of experienced return borrowers and then also people wanting to get involved with it. I would say there's not a frenzy as it was in 2020 and 2021 where there's a lot more events. There's not as many events nowadays as there used to be. There's not as many, I don't see as many people, marketing. People are flipping homes in your neighborhood type radio ads and TV ads, come to my seminar, join our group, and we'll teach you how to flip homes. There is some of that, but I don't see the frenzy as it used to be. And so I would say the number of new borrowers getting involved is less than what we've seen in the past. But it's just a healthy market for flips because you can get really good deals. There's a lot of, if you have to sell and your house is not in good shape, these investors are picking them up for great prices. And when they do the remodel right, they're getting multiple offers. I mean, take Austin, for example. Every article I read about what markets are going to go upside down, Austin's in all of them. But it is one of our best markets right now for loans, for turnaround times. And it's like, well, I'll read all this stuff that Austin's not a good market, but what I'm seeing, like actually doing the loans there, is it's great. I would love to do as many more loans in Austin as I can because they're getting them for a great price for whatever reason. And then when you have a nice rehab home there, it sells quick and it's even getting multiple offers. And so maybe the market as a whole might be dropping a little bit there, but investors are loving it. They're doing great.
So if I understand what you're saying, if you have a property that is in really good shape and has a lot of nice features, it's a good property versus not so much, those are still selling. The good properties are still selling. It's the not so much that used to be selling like pancakes because people would just buy anything. Those are then staying on the market. But if it's a good solid property, those are still moving. Is that accurate from your experience?
Yes, absolutely. And I think it's hurting the first-time borrowers, the first-time investors that are getting involved in the market, especially if they're doing the work themselves, because when they're doing the work themselves to try to save a little bit of money, the quality is not as good. And the experienced borrowers know I need to hire a contractor that knows how to turn a flip house quickly with high-quality work, high-quality materials, and then some design choices that really appeal to the buyers that are out there, which are, you're going to have the FHA buyers. You're always going to have them. But, and it's the return borrowers that are really, I see, excelling right now. And then the first-time borrowers, they're the ones that if they don't do the higher quality rehab, those homes are sitting and they're struggling a little bit.
Now, what about the short-term rental space? So that would be in to some extent a space that would fall in that kind of that recent category you were talking about of, I'm gonna put 30, 40 grand into this, really make it nice and do a couple things. But of course, they're in it for the long term to sit in short-term rental. Are you seeing much of that anymore? Or has that space really been hit hard with the economy?
Yeah, it's tough. It's eliminated one of our exit strategies, which is hard for our borrowers because before they had a house, they remodeled it nice, and they decided, I don't want to flip it and make, whatever, 10, 20,000. I'd rather keep it as a short-term rental or a long-term rental. They had some options there. I don't see that too much anymore where people are buying a house and keeping it as a short-term rental. I've got short-term rentals. They did great for a while. Right now, they're just paying for the mortgages and the costs, which is fine with me because I've had them for a while. But if I was a first-time investor or new to it, and I'm trying to make some money here, I'm not just trying to get through my costs because it's oversaturated. There's more on the market than people are renting them. And so there's certain days, holidays fill up, weekends fill up, but getting those weekdays for a lot of my properties are difficult.
Well, And long-term rentals have to be tough in this market because let's say they get a smoking deal on the property.
Mhm.
They come to you, they close, they put 40 grand into it. It's nice and fixed up, ready for a tenant. They can, receive good rental value, top rents. And in Phoenix, rents are pretty high. And especially, certain parts of Phoenix, like the East Valley and Scottsdale and those types of areas tend to be, on the high end. However, they do all that and then they're going to basically refinance out because that's, you're a 6-month product. They're going to refinance out, but their rates aren't going to really allow that property to cash flow, are they? I mean,
Yeah, it
it's
stinks.
still an investor type rate and it's going to be higher than your owner occupant rate, right?
Yeah, like right. I mean, that DSCR loan that I almost refinanced into 9.99%. It's like, I get it. Like, that's where the rates are. There's no cash flow in it. Normally, when you buy a rental, you're looking for 4 benefits. You want the cash flow, you want the tax depreciation, you want the appreciation, and then you want the equity pay down. Well, right now, so 3 years ago, we were getting those 4 benefits. Today, there's only 2 benefits. There's no cash flow, and there's very little appreciation. So you still get the tenants paying down your mortgage. So you get that equity pay down. You get the tax breaks.
Right.
So if you take a little loss right now, take a little loss each month, and then but also not much appreciation, it's hard to buy a rental and make it make sense unless you're really planning to hold it long term.
But is that really a viable strategy? And the reason why I ask is back in 2008, Andy and I did a lot of starting in 2008 all the way to, 13, we did a lot of short sale and foreclosure consultation. And there were so many landlords that I met with that had, say, 10 properties. They were all underwater, negative cash flow. And, they bought them with the idea of, at some point, this is going to work out, right? I mean, I'm about break even, but I got the tax benefit. But then 3 years later, it's like, I'm losing money every month and I'm putting it in and now I'm hosed. I mean, to me, that's concerning that people even would, and there's smarter minds. I mean, there's people that are out there investing and doing well with these types of strategies, but it concerns me that if you're only going for those 2 things and you're not really focusing on the cash flow and there's another dip in the market, even if a slight dip, which generally will result in a lower rental rates as well. Like it's not sustainable. We're going to start seeing a bunch of foreclosures on these, investment properties.
Yeah, no, totally likely. It's a couple $100 loss a month isn't the big deal. It's when the AC goes out. You're like, because when you're not making any money on that property, you're not able to build up any reserves for when repairs come. And so, yeah, I'm losing $200 a month, but I got a lot of equity in the property. I'm getting, you can justify it, right? But then the AC unit breaks. You're like, okay, now I have to pay $9,000. This is such a problem. Time for me to sell. Yeah.
Right. And then you flood the market. And then of course it just further causes depreciation. So it's, it's interesting.
I don't know how we're going to get out of the market. I mean, I thought about it. It's so interesting because we got, there's no homes on the market, but there's no buyers. Like, if interest rates drop, I could see it helping. But if interest rates drop, does that mean that more people are going to put their homes on the market? Maybe.
Yeah,
probably. It
Well,
depends on how far.
Yeah.
Nobody's putting their house on the market because they all have the golden ticket, right? Which is the below 4% interest.
Yeah.
And the likelihood of seeing that any time in the near distant future, or maybe even in our lifetimes, again, is not happening. So it's like, why do I mean, it makes no sense. And those properties cash flow.
Yep.
And so like, why am I going to give up that interest rate? I'm going to just turn it into a rental and, hold it for the rest of my life. I mean, it makes sense, and let the tenant pay down my mortgage. I'll own a free and clear asset. It'll be great. And so if you own a property with that and you have to move, you can easily turn it into a rental. And that's what people are doing. I mean, I found in my limited experience, I've bought a couple of properties over the last couple of years. And my experience has been the reason why those properties are being sold are generally three reasons. Divorce, the owner goes into like an assisted living facility, or the owner dies. And that's it. People aren't voluntarily putting their houses on the market with, that when they have that below 4% interest rate. My thought is, and whether or not the feds would do this or what the ultimate ramifications are, I'm not an economist. Man, why isn't somebody going in and pressuring, Fannie Mae, Freddie Mac to make or allow their loans to be assumable with a 60-day application process?
Yeah.
And if you do that, you're going to start adding to the inventory because, sellers are going to be like, oh, well, if I let somebody take over my loan, I can go do that with somebody else, and it's very doable as long as I can qualify. But instead, now they're doing those cash out seconds. Have you read about that? Where you can pull out cash out seconds so you can remodel your property further, causing people not to want to sell because it's like, well, my first is low interest rate. So yeah, if I go get 50 grand cash out from Fannie Mae, Freddie Mac at a decent interest rate for 30 years, I can do that addition to the house instead of going and buying the house down the street that has it already on there, now we're even, contracting the inventory.
So it's an interesting conundrum we're in. It'll be interesting to see where it goes. I think interest rates dropping will help, but I don't know if they will. So,
So Andrew, break down for us. So if we've got a new real estate investor that's listening to this and thinks, okay, this is a tool I need to add to my tool belt, hard money lending. What can they do to make themselves most attractive? Somebody who doesn't have, they're coming in new, maybe they haven't done the flip and everything else. When they come to you and find, or any hard money lender, what do they need to be thinking in terms of making themselves most attractive to be able to obtain that financing?
Yeah. As much education as you can, be connected to as many people as you can, forming a team first, is always a good thing. If they bring me a property and the property's great, I'm going to go, well, who's your contractor? Who's your real estate agent? Has this contractor remodeled flip homes before? Because there's a big difference between contractors working with homeowners and investors, and how fast can they perform, and what's their price and their quality. And then, the real estate agent's the same way. Does this real estate agent have experience listing investment properties, flip properties, or have they been working with homeowners most of their career? And then just their general knowledge of terms and how to calculate ARV. Something that I'll ask someone is if there's not any red flags, but maybe a few yellow flags. I'm talking to them and they've said a few things that are like, I'm not sure if this person, has quite the knowledge or experience yet. And I'll say, well, I'm not sure. I'll tell them, I'm not sure about the value of this property. Can you provide me with a CMA? And then I'll see what they send me. Are they sending me stuff directly from the MLS? So do they have access to the MLS? Are they sending me screenshots of homes they saw on Zillow? Are they sending me a nice, organized, comparable analysis report or a CMA from like a PropStream or a Propelio type website? And then it gives me a further step of, okay, this person's taking a few steps and has a subscription to PropStream, or they have access to the MLS to get these real comps. Or if they're sending me screenshots of Zillow and Redfin properties, I'm like, okay. Or if the CMA is directly from their realtor, and I look at the CMA and it's just crap, like the realtor didn't know what they're doing. I'm like, okay, they're trusting in someone to buy this house that also doesn't know what they're doing. And those yellow flags become red flags.
Yeah, so it seems like the underwriting is so much more about the plan, the execution, than it is about, a credit score or, this or that. I wonder how often do you work with investors, first-time investors that were members of teams that you knew a part of other investors that were borrowers from you? In other words, they weren't the initial borrower, but they were a part of a team, and you knew their experience from that perspective, and it made it an easier leap from the perspective of a lender.
Absolutely. One of the reasons why I love visiting job sites, because if I'm talking to the borrower, I like the borrower, they're doing a great job. I go to the job site, and part of the reason they're doing a good job is because the contractor they're using knows what they're doing. First person I'm talking to is that contractor, and I'm saying, hey, why don't you go flip a home? I'll lend to you. I love your work. All you got to do is find a property and let me connect you to these wholesalers who have these properties, just like this investor. So instead of you just making X amount, being the contractor for the property, you'll do the work yourself, saving money, and you'll make a whole lot of money flipping a property. And so, and then any partners involved, real estate agents, the same thing. If the realtor's listing that flip property, I'm saying, hey, I'll lend to you too, just like I lent to this borrower.
So when you finance both the purchase and the construction, are you working off a construction schedule or budget? Or is it just, how's the cash distributed, I guess, once the purchase is done for the construction component?
Yeah, so I have the borrower provides their own scope of work. And then when they take rehab draws in that scope of work, they can put it together themselves. So they could have had their contractor put it together. And I know, budgets change and sometimes they go over or under. What I say is once we close the loan, I can't change your loan. It's recorded, it's insured. You have $60,000 for rehab. That's what it is. Mm-hmm. So if you go over that $60,000, that's fine. You just got to cover the overages. No, I can't redo the loan unless we go back to title and pay all the fees again. But within that $60,000, you can change the budget however you want. So let's say you plan to do, let's say the foundation, you knew there's a foundation issue and you plan to put $10,000 into it. Well, it's actually $18,000 when all the work's done. We're like, okay, so maybe the flooring that you wanted to do, can you cut back a few thousand there and cut back a few thousand on the cabinets and still make it look nice? Then we're still in budget, we're fine. And then so with the rehab draws, they're done by completed work. So they just send in pictures to me. If I see the work's completed and then it follows the scope of work, then I just release those funds to them.
Well, Andrew, we really appreciate you taking the time to be with us. Great information about hard money lending. Tell our listeners how they can connect with you and Boomerang Partners. Yeah,
so Andrew at boomerangcapital.com is my email. And then my cell phone. You can find me on social media too. I'm the best flipping lender on Instagram and TikTok. Andrew Bang, just look up my name. But call me, message me, email me. I'm here to help. I want to add value to what investors are doing. One thing I do not want to be is a hurdle an investor has to overcome to buy a house. I want to be a value add, a member of their team. If I try to make hard money as easy as possible, I put my loans together like an investor, not like a mortgage lender. Lending is not my background. It's flipping homes. I understand that side of it. I'll give you my honest opinion about any property. If there's not enough room in the property, I will tell you the only people that are going to make money on this deal is me, your real estate agent, and your contractor. There's no money left in this deal for you because you get paid last. The investor is the last person that gets paid in a deal. And so if it's a tight deal, there's other deals out there. Let's find something that works for everybody.
All right. Andrew Bang, Boomerang Capital Partners. Thanks so much for being with us. Let's do it again soon.
Hey, absolutely. Thanks, Sean. Thanks, Andy.
All right.
Thanks,
see you next time. With that, everybody, that is our show. Make sure to join us at 2 p.m. Today for The Collective, and we'll see you next week.
Have a good day, everyone.